I do want to welcome in our next guest, though, broaden out our focus. Joining us this morning, Dale Smothers, President and CEO at RDS Wealth Management. Dale, great to see you. I haven't seen you in the new year. Happy New Year to you.
Happy New Year.
Thank you. Alex and I were just talking about Alibaba, but really more focused on all these headlines we're getting in 26. It's very much a headline-focused market. We're driving through these headlines, but we also seem to be shrugging them off pretty easily. I mean, we see these moves, but then we just flip right back. What are some of your takeaways from the market action we've seen this year so far?
Marley, what a read on the market so far. It's exactly right. It's driven by headlines, then we shrug them off. So here's the word going into 2026. We talked about this right before 2025 ended. Discipline. We've got to maintain discipline, stick with the plan. There are a lot of reasons that we are optimistic here. RDS Wealth is very optimistic going into 2026. We had a GDP print that was unlike anything we've seen in a long time. We've got an incoming Fed chair, at least by the admission of Donald Trump, that will not look at the GDP number as a reason to raise interest rates. So perhaps continued in a cutting trajectory here into 2026. We've got growth like we've not seen, productivity like we've not seen, and earnings season is coming up on us. I think these headlines are going to be ones that we consume as an investor, and we see the market go higher on the backs of that, continuing to climb this wall of worry into 2026.
So as we continue to climb this wall of worry, what are some of the risks? What would make us fall off here?
Yeah, the biggest underlying risk. I mean, theoretically, Greenland's behind us, right? So the biggest risk that's going to persist throughout 2026, Marley, is what if AI is either not profitable or companies realize that there's no need to continue to build out this infrastructure that they are currently doing. This AI infrastructure build out has produced what we've seen in 2025 going into 2026. I think it continues. If the questions begin to be answered with, well, we're just not sure how we're going to turn this into profitable businesses, or how we're going to continue to consume as much energy as we need for these data centers, or maybe there's a more efficient way out in space, this could cause a little bit of a headwind for the market. And that is, in our opinion at least, one of the biggest underlying risks that we know today.
So if discipline is the most important way that we might handle that and combat that, how should we be approaching the potential that AI might not play out how it's expected? And also, where are you seeing opportunity that you do expect to play out how it's expected?
Certainly. I think some of this opportunity is in the fact that headlines do move the market in a way of overreaction, Marley. We saw this Greenland announcement, and within days, we saw percentage points. When you start measuring index moves in percentage points, we're in a sell-off. And what that means is that a lot of the underlying stocks that make up that index have fallen significantly lower than the overall index. So here's our number one strategy that we have right now, is that we're heavy for optimistic money, for long-term growth money. We're heavy in the indexes, S&P 500, for instance, or the NASDAQ. We buy SPY, QQQ. We hold them and then buy into names that get oversold. For instance, a great example is Royal Caribbean. Royal Caribbean in their little bit of a downtick here. We've bought more of that. We've been buyers of Royal Caribbean for over a decade now. Good, strong dividends, nice earnings. They are currently cutting their debt. That's a very good place that we see opportunity to not only get continued growth, but also a little bit of a dividend in return there as well. So there's one strategy that we use, is being heavy in the index and buy the names that get pulled down, perhaps due to a headline of some kind.
And Dale, you unknowingly picked one of my daughter's favorite companies. She's a big fan of Royal Caribbean Cruises. So
why not?
Let's stay with Royal Caribbean here. Royal Caribbean has had a bit of a pullback over the last 6 months. What makes this one different than some of the others that we've seen in travel and leisure?
Yeah, the reality is they've got the perfect mix where you've got a young couple that can take a trip there and have fun. You've got children that can take a trip there and have fun. And the reality is, in this industry, they are the leaders in terms of earnings and actually turning that into a profitable business. Not to mention the fact that they are currently actively trying to dial back their debt, they're paying back debt with their revenues, and they have a buyback program that they've recently announced. I think this is the time to take advantage of that business model and buy more of Royal Caribbean if you already own it. Now, clearly, that's not a recommendation for all. Let me be very clear here. Our book of business, what we are doing with our clients, is we're taking advantage of that dip for those who are long-term focused and want a little bit of a dividend in return.
And Dale, I want to talk about the Fed. You mentioned the Fed in your first answer, and obviously an important part of any outlook for the year as we are getting a new Fed head in 26. The president seemingly signaling he has a pick in mind. We have some hints of who that might or might not be at this point. What do you think the overall market response is going to be when we do finally get that new Fed head? And what action will immediately follow this new placement?
Yeah, so Marley, the uncertainty is never a good thing for the market. And so, I've got a pick and now I don't have a pick. I think right now the market's kind of tuning that out. As we get closer to the time, what does Chairman Powell do now? What does he stay with the Fed? That might cause a little bit of a headline. But when he is officially replaced, I think that particular certainty brings a little bit of ease to the market. And then once we realize what this particular Fed chairman initiative will be, if it's cutting into 2026 to get to what I believe is the more neutral rate, which here's a little bit of I guess we'll call it a guess more than anything, but I would say foreshadowing. I think the Fed's going to look to be around 100 points lower than where we are today, and the market will certainly find that favorable in terms of stock prices for sure.
All right, Dale. Well, I love to close out on a little bit of speculation. When we get that move, if we get it, we'll revisit this conversation and talk about how you got there. We'll pick it up. But Dale, thank you so much for being with us. Always a pleasure to see you and talk to you. Dale Smothers, President and CEO at RDS Wealth Management.